Somewhere right now, a retiree is standing at a pharmacy counter, handing over a card for a medication they've already paid too much for this year, because nobody told them there's a dollar amount where that stops. Somewhere else, a retiree just opened a hospital bill for a number with 5 digits in it, and they're already planning which payment plan to call about, without knowing that same hospital may be required, by law, to erase some or all of that balance for people in their situation. And somewhere else, a retiree on a fixed income is dreading the property tax bill that lands every year like clockwork, without knowing their state may let them freeze it, defer it, or cap it against their income. None of these people did anything wrong. They just never heard the right words said out loud, in order, in one place. So that's what this video is. 5 categories of costs that federal or state programs already let eligible people reduce, freeze, or eliminate legally, without penalty, without gimmicks. I'm going to name the program, explain who qualifies, and tell you exactly what to say when you call. Stick around for the last one because it's the one people ask me about the least, and it can be the biggest dollar amount on the whole list. Who this is for, and a quick honest note. Before we get into it, I'm not a CPA, an elder law attorney, or a benefits counselor, and this isn't personalized advice. Every one of these programs has its own eligibility rules, and some vary a lot by state or by hospital. I'll give you real numbers where they're stable nationally and point you to where to check your own state's or provider's specific rules, because that's the only way to get an accurate answer for your situation. Think of this as a map showing you where the doors are. You'll still need to walk up and knock on the ones that apply to you. If this is useful, subscribing helps more of this kind of content reach people who need it. But more importantly, if you know a retiree who's stretching a fixed income, send them this video. That's worth more than any button. Why this happens. Here's something worth saying plainly, because it's easy to slip into a darker story than the facts support. I don't think there's some coordinated effort to keep this information from you. What's actually going on is simpler and, in a way, more mundane. These programs sit inside dense federal statutes, state-by-state regulations, and internal agency manuals that run hundreds of pages long. Frontline staff, the person answering the pharmacy phone, the hospital billing clerk, the county assessor's office intake worker, are usually trained and measured on processing the transaction in front of them, not on walking you through every relief program you might theoretically qualify for. That's simply not built into most of their job descriptions, and, in a lot of cases, the specific eligibility rules for a program run by a different department may not even be something they've been trained on. There's also a structural reason this stays quiet, worth naming without dressing it up as a scheme. Collecting the full amount tends to be the default, low-effort outcome for these institutions, while flagging a program that reduces or erases what you owe takes an extra step that nobody's specifically required to take. That's not malice, it's just how incentives tend to sit when disclosure isn't written into anyone's job description. The result is the same either way. The burden of finding out falls on you. Multiply that across 5 different kinds of bills, each run by a different agency with its own paperwork and its own deadlines, and it's easy to see why so many retirees on a fixed income end up quietly paying more than they legally have to, not because they did anything wrong, but because nobody ever laid all 5 programs out together, in plain language, with the phone numbers attached. So let's remove that burden right now, one program at a time. Bill 1, your Medicare Part D prescription costs. Let's start with medication, because this is the one most retirees are already paying every single month. Federal law now caps what you can be required to pay out of pocket for covered prescription drugs under Medicare Part D, including Part D coverage built into a Medicare Advantage plan, in a calendar year. For 2026, that cap is $2,100. This includes your deductible, your copays, and your coinsurance for drugs your plan covers. It does not include your monthly premium, and it doesn't apply to drugs your plan doesn't cover, or to certain drugs administered in a doctor's office that fall under Medicare Part B instead. Things like some infused cancer treatments. Once your covered drug spending crosses that $2,100 line for the year, your cost for those medications drops to $0 for the rest of the calendar year. Not a smaller copay, $0. This isn't new legislation nobody's heard of. It's a provision from the Inflation Reduction Act that's been phasing in. The cap was $8,000 in 2024, dropped to $2,000 in 2025, and is $2,100 in 2026, adjusted for inflation. But here's the catch. Nothing at the pharmacy counter announces when you've crossed it. There's no banner, no letter that arrives the week it happens. You have to know the number exists and actively track where you stand against it. Picture someone like a retired school teacher managing 2 or 3 chronic conditions, paying somewhere around $150 to $200 a month at the pharmacy. If she crosses that $2,100 threshold in, say, August, but nobody flags it, she could easily keep paying full price straight through December, months of payments she was never required to make. 2 more pieces worth knowing. Extra help, officially called the low-income subsidy, administered through the Social Security Administration. If your income and resources fall under certain limits, which are adjusted every year, extra help can push your Part D drug costs down to nearly nothing well before you'd ever reach the $2,100 cap. A lot of people assume they earn too much and never actually check the current numbers. Since the thresholds change annually, the only reliable way to know is to check ssa.gov or call Social Security directly. The Medicare Prescription Payment Plan. If you take an expensive medication early in the year and don't want to feel the $2,100 all at once in January or February, Medicare lets you opt into spreading that cost across monthly installments for the rest of the year instead. It doesn't lower what you owe, it just changes the timing, which can matter a lot on a fixed income. You have to opt in, generally before you fill your first prescription for the year under the plan, and enrollment is not automatic. It's also worth being precise about what the cap doesn't cover, because this is where people sometimes get an unpleasant surprise. It applies only to drugs your specific plan's formulary actually covers, not your monthly premium, not medications your plan excludes entirely, and not certain high-cost drugs that get administered in a doctor's office and billed under Medicare Part B instead of Part D, like some infused cancer treatments or injectable therapies. If you're on an expensive specialty drug, it's worth a call to your plan to confirm whether it falls under Part D or Part B, because that distinction determines whether this $2,100 cap actually protects you for that particular medication. What to do? Log into your account at medicare.gov. Your year-to-date out-of-pocket drug total is listed there. If you don't have online access, call your Part D plan's member services line and ask them to read you that number. If you're close to $2,100 or already past it, confirm with your plan and double-check at the pharmacy counter that your zero-cost status has actually kicked in, not just that it's reflected somewhere on paper. Bill 2. Your hospital bill. This one surprises people the most, because most of us are raised to think of a hospital bill as about as negotiable as a boulder. The majority of hospitals in the U.S. are nonprofit. In exchange for the tax-exempt status they receive, federal law, specifically Internal Revenue Code Section 501(r), requires those hospitals to maintain a financial assistance program, commonly called charity care. This isn't a rumor or a loophole. It's a documented statutory requirement tied directly to a hospital's nonprofit tax status. Income thresholds vary hospital by hospital, since each one sets its own policy within federal guidelines, but a common pattern uses multiples of the federal poverty guidelines. It's not unusual for a single person with income at or below the poverty line, or somewhat above it, to qualify for full elimination of a bill, with a sliding scale of partial discounts extending well beyond that. Some hospitals extend meaningful discounts to households earning 2, 3, or even 4 times the federal poverty line, especially for large bills. The only way to know your specific hospital's cutoff is to ask for their policy in writing. Picture someone like a retired postal worker living on Social Security and a small pension, handed a 5-figure bill after a hospital stay, offered nothing but a payment plan by the billing office. If his income falls within that hospital's charity care guidelines, some or all of that bill could be eliminated under their own written policy. He'd just need to apply. The form is called a financial assistance application, and under federal law, every qualifying nonprofit hospital is required to have one. If it's not posted clearly on the hospital's website, call the billing department and ask for it by name. A useful sentence to use on the phone. I'd like to apply for financial assistance under your charity care program. A few more details worth knowing. Under Section 501(r), hospitals are required to make a reasonable effort to determine whether you qualify for financial assistance before sending your account to collections or reporting it to a credit bureau. Hospitals are required to publish a plain language summary of their financial assistance policy along with the application itself. If a bill has already gone to collections, that doesn't automatically disqualify you. Many hospitals will still process an application retroactively and pull an account back from collections, though the exact window varies by hospital, so ask specifically. Look for the hospital's Community Health Needs Assessment, a document most nonprofit hospitals are required to publish, which often lists current income guidelines for assistance. It's worth applying even if you're not sure you'll qualify. The income thresholds hospitals use aren't uniform, and a policy that looks strict on paper sometimes turns out to be more generous in practice, especially for large bills tied to a single hospitalization or procedure. The only way to know your specific hospital's actual cutoff is to ask for the policy in writing, or to look for that Community Health Needs Assessment document I mentioned, which many nonprofit hospitals are required to publish, and which often spells out current income guidelines in plain terms. One more thing worth knowing, this requirement applies specifically to nonprofit hospitals, which make up the majority of hospitals in the country, but not all of them. For-profit and government-run hospitals aren't bound by Section 501(r) in the same way, though many still maintain their own financial assistance policies. It's just not a federal tax status requirement for them the way it is for nonprofits. So if your bill came from a for-profit facility, it's still worth asking about financial assistance. The legal backing is just different. What to do? If you have any unpaid hospital bill from the past year, call the billing department and ask for a financial assistance application by name, referencing Section 501(r). Ask specifically whether they accept applications on accounts already sent to collections. Bill 3. Your property tax. Most homeowners assume property tax is the one truly fixed cost in retirement. In many states, it isn't, at least not for seniors. Most states run some kind of freeze, deferral, or credit program for residents 65 and older, and they work differently depending on where you live. A freeze locks your assessed tax at the rate from the year you qualified. Your home's value can keep climbing at reassessment, but your tax bill doesn't have to follow it. A deferral goes further, suspending your obligation to pay some or all of the tax until the home is sold or transferred, usually with interest accruing at a capped rate, often lower than what you'd pay on a typical loan, though the exact rate depends on the state. Some states run a circuit breaker program instead, which caps the share of your income that can go toward property tax and refunds or credits the difference. The specifics genuinely differ by state. As examples, Texas offers an age 65 school tax freeze with no income test attached. New Jersey's Senior Freeze program reimburses the difference between your current property tax and a base year amount from when you first qualified. Washington State ties its senior exemption to an income limit that's adjusted periodically. Every state's program has its own name, its own income rules, if any, and its own filing deadline, often early in the calendar year, so a general search of your state senior property tax exemption on your state or county government site is the fastest way to find your specific numbers. A few practical notes. Deferral programs typically require you to have lived in the home as your primary residence for a minimum number of years. And if you still carry a mortgage, some programs require your lender's consent before you can defer. Since a deferral is effectively a loan against the home's future sale, it's worth discussing with anyone who might inherit the property so there are no surprises later about the balance owed. Picture someone like a retired nurse whose property tax climbs a little every time the county reassesses. If her state has a homestead or senior exemption she's never filed for, she could be leaving years of savings on the table simply because nobody flagged the deadline. And unlike some programs, these often aren't retroactive, so a missed year usually can't be recovered later. If you're a lower income senior, a deferral can take your current tax obligation off the table entirely until the home eventually sells, freeing up monthly cash flow you're currently spending on a bill that doesn't have to be paid right now. If you're a more comfortable retiree simply worried about rising assessments, an age-based freeze can protect your budget from future increases regardless of income level, since many freeze programs don't have an income test at all. Either way, the only cost of checking is a phone call or a search on your county's website. These programs don't charge an application fee, and missing the annual deadline is usually the only way to lose out. What to do? Search your state's name plus Senior Property Tax Exemption on an official .gov site. Find the program name, the income limit if there is one, and the filing deadline, and put that date on your calendar now. Bill 4. What you owe the IRS. Of everything on this list, the IRS tends to inspire the most fear, and fear makes people pay first and ask questions never. But the agency operates under its own written rules about what it can and can't do to someone with genuinely limited income, rules that exist whether or not anyone volunteers them to you. The IRS has a formal classification called Currently Not Collectible, CNC, status. Under the Internal Revenue Manual, if your income falls at or below the IRS's own allowable living expense standards, the agency can place your account in CNC status, which halts active collection, no levies, no garnishment of wages or benefits, no further collection calls, for as long as the classification is in place. The underlying balance doesn't disappear, and interest can still accrue, and a federal tax lien already on file doesn't go away either. But nothing can move against you while you're in CNC status, and it can be reviewed and revisited if your income later changes. For a lot of retirees living primarily on Social Security, the income thresholds that qualify for CNC are well within reach. Picture someone like a retired cafeteria worker who owes a few $1,000s from a year she worked part-time and had tax withheld incorrectly. Living on a modest, fixed Social Security income with no real way to pay, she may well qualify for CNC classification, which would stop collection letters and calls, though not erase the underlying debt. Two more tools worth asking about on the same call. First-time penalty abatement under IRS Policy Statement 20-1. If you have a clean compliance history, generally no penalties in the prior 3 years, you can ask to have assessed penalties removed. Penalties can equal or exceed the underlying tax itself, so this alone can meaningfully shrink a balance without any negotiation. Offer in compromise, part of the broader Fresh Start initiative. This is an agreement to settle your tax debt for less than the full amount owed, based on your realistic ability to pay. It's a more involved process than CNC status and won't fit every situation, but for someone with a fixed income and few assets, it's worth asking about. CNC status and an offer in compromise aren't mutually exclusive. You might end up eligible for one, the other, or both. One more detail worth knowing before you call: CNC status isn't necessarily permanent. The IRS can periodically review your account, and if your income later rises above the threshold, collection activity can resume. It also doesn't stop interest from accruing on the balance, and it doesn't remove a federal tax lien that may already be on file against your property. But for as long as it's in place, it does stop the levies, garnishments, and collection calls that make an already difficult financial situation harder to manage. And for someone living on a fixed Social Security income with no realistic way to pay a balance down, that alone can be a meaningful difference. It's also worth remembering that the IRS representative you speak with is generally there to help you find the option that actually fits your numbers, not to talk you out of one. Bringing all 3 questions to the same call, CNC status, penalty abatement, and offer and compromise, means you only have to have this conversation once. What to do? Call the IRS directly at 1-800-82-91040. Have your most recent tax return and a simple list of your monthly income and expenses ready, and ask specifically about currently not collectible status, first-time penalty abatement, and offer and compromise eligibility, all on that first call. Bill 5. Your home energy bill. This is the one I hear about the least, and for households genuinely struggling, it's often the largest dollar figure on this whole list. It's called the Low-Income Home Energy Assistance Program, or LIHEAP. It's federally funded and administered state by state, and it can pay not just your ongoing energy costs, but past due balances already sitting on your account, including ones close to a shutoff notice. You don't need zero income to qualify. Federal law sets the maximum eligibility at 150% of the federal poverty guideline, or 60% of your state's median income, whichever is higher, and states can't set their limit above that ceiling, though they can set it lower. In practice, that threshold covers a meaningful slice of retirees living on a fixed income. As a rough national reference point, 150% of the federal poverty guideline for a single-person household lands somewhere in the neighborhood of $23,000, $24,000 a year. Though your specific state's number may differ, some states use the state median income formula instead, which can be higher. Households already receiving SNAP, SSI, or TANF are often automatically considered income eligible in many states, without a separate income review. Picture someone like a retired home health aide who had to cut back her hours during a difficult stretch. Her electric bill climbs through the winter, a past due balance builds, and she's weeks from a shutoff notice, weighing that bill against a medication copay. If her income falls under her state's LIHEAP threshold, that program could cover both the current bill and the past due balance. Money that, for a lot of people in that position, never makes it into any conversation at all unless someone happens to mention the word LIHEAP out loud. A related program worth flagging, Lifeline, run by the FCC, which can bring a qualifying low-income household's monthly phone or internet bill down significantly, and is administered separately from LIHEAP, but often serves overlapping households. And a second protection that tends to travel with the same households, if your income and resources qualify you for your state's Qualified Medicare Beneficiary, QMB program, one of several Medicare savings programs run at the state level, the state pays your Medicare premiums and cost sharing directly. Under federal law, providers are generally barred from billing QMB enrollees for the deductibles, copays, or coinsurance that Medicare would otherwise leave to you. In practice, providers do sometimes bill these amounts by mistake anyway, simply because their billing systems weren't updated to flag your QMB status. If you're enrolled in the program and you find old bills you paid that you technically shouldn't have, it's worth calling your state Medicaid office or the provider directly and asking about getting that money back. You may be entitled to a refund you'd otherwise never think to request. LIHEAP isn't only about paying down a bill either. Many states use part of their LIHEAP funding for weatherization assistance, sealing drafts, upgrading insulation, repairing or replacing an aging furnace, which lowers your energy costs going forward, not just what's already past due. Some states also run a separate summer cooling assistance component for households facing dangerous heat. Because LIHEAP is state-administered and funding is limited, some states process applications on a first-come basis until that year's allocation runs out, which is part of why applying early, rather than waiting for a shutoff notice, genuinely matters. If you're a lower-income senior, LIHEAP can potentially wipe out both a current bill and a past due balance before a shutoff ever happens. If you're a more comfortable retiree who's had one genuinely difficult year, a medical event, a death in the family, a temporary drop in income, it's still worth checking, since eligibility is generally based on your current income, not your income in a typical year. A household that wouldn't qualify most years might well qualify during a specific hard stretch. What to do? Go to liheap.acf.hhs.gov, find your state's program contact, and gather your most recent utility bill, income documentation, and Social Security award letter. Most states accept applications year-round, though funding availability can vary through the program year, so applying sooner rather than later matters. Your action plan. You don't need to do all 5 of these in one afternoon. Pick the one that matches your situation right now and work through the rest over the coming weeks. Step 1. Check your Medicare Part D total. Log into Medicare.gov and find your year-to-date out-of-pocket drug spending. If you're near or past $2,100, contact your Part D plan and confirm your zero-cost status has actually applied at the pharmacy, not just on paper. Step 2. Request hospital financial assistance. If you have any unpaid hospital bill from the last year, call the billing department and ask for a financial assistance application by name, referencing Section 501R. Ask whether they accept retroactive applications on accounts already in collections. Step 3. Look into a property tax freeze or deferral. Search your state and county's official government site for senior property tax exemption. Note any income limit, check whether lender consent is required if you carry a mortgage, and mark the filing deadline on your calendar. Step 4. Call the IRS if you owe a balance. Dial 1-800-829-1040 with your most recent return and a monthly income and expense list ready. Ask about currently not collectible status, first-time penalty abatement, and offer in compromise on the same call. Step 5. Apply for LIHEAP and Lifeline. Go to liheap.acf.hhs.gov, find your state's program, and gather your utility bill, proof of income, and Social Security award letter. Ask about weatherization assistance while you're on the phone, and apply before you're behind rather than after a shutoff notice arrives. A note on safety. Every program on this list is free to apply for. There's no legitimate version of any of these that requires an upfront fee, a wire transfer, or a gift card to process your application. If anyone contacts you claiming they can fast-track one of these programs for a charge, that's not how the real programs work, and the safest move is to hang up and go straight to the official source yourself. Medicare.gov for Part D, the hospital's own billing office for charity care, your county assessor for property tax relief, the IRS directly at 1-800-829-1040, and lieheap.acf.hhs.gov for energy assistance. Close. None of these 5 programs are secret in the sense of being hidden from the public. They're written into federal statutes, IRS manuals, and state law, and any of them can be found with enough digging. What they have in common is that the institution collecting your money usually isn't the one that's going to bring them up. That part's on you. But now you have the names, the sections of law behind them, and the phone numbers to call. That's most of the hard part already done. Disclaimer. This video is for general educational purposes only and isn't personalized legal, tax, or financial advice. Program names, income thresholds, and eligibility rules vary by state, by hospital, and by individual circumstances, and they change from year to year. Figures cited here reflect publicly available guidance as of 2026. Always confirm current details with the relevant agency, hospital, or a qualified professional, such as a benefits counselor, elder law attorney, or CPA, before making financial decisions.